Hey everyone, welcome back to Actual Investing. Happy Tuesday. Today I'm going to be talking about 3 small cap software stocks that are all profitable, that are all at or near all-time lows. So small cap stocks in particular have been hit really hard by the economy lately. As interest rates are staying higher for longer, I think the market is just not very optimistic on these small software stocks. So we're going to look into them and see whether any of these present a nice buying opportunity. So the first one I want to talk about is DoubleVerify Holdings, ticker DV. So DoubleVerify is an ad tech company. Essentially, it's a company that helps advertisers ensure that their ads are seen in a brand safe environment by a real human. So those are the 2 factors that spur the name DoubleVerify. So DoubleVerify has a couple of tailwinds going for it. For one, as internet privacy concerns continue to run rampant in this world where everybody's concerned about their privacy, there's a big push to get rid of cookies, which are essentially ways that corporations can track your interests based on your web history. They leave a little trail of cookies wherever you go, kind of thing. Now, DoubleVerify does use cookies, but can also thrive in a cookieless world because they have their own analytics that they use that don't need cookies. So, whether we continue down this path of using cookies for advertising analytics or if we get rid of them, DoubleVerify stands to benefit. Now, what does DoubleVerify actually do? This is from their investor relations page. They say they're driven by a mission to make digital advertising stronger, safer, and more secure. We help brands improve the effectiveness of their online advertising, giving them clarity and confidence in their digital investment. So that was a lot of buzzwords, but essentially what we're looking at is a company that helps optimize a business's ad spend, making sure that they're getting the most out of their advertising budgets. If you've ever worked for a small business, as I have, you know that advertising is huge, and it's probably the biggest expense that goes into growing a business because you can't grow your business if you don't advertise. So if companies are going to be spending a lot of dough on advertising, they're going to need to make sure they're seeing a return on that investment. I've worked for some companies where we did not see a return on that investment, and it sucked. It really, really is disheartening to pour all this money into ads with it not turning into sales. So DoubleVerify ensures that your ads are being shown to the right people in order to drive a positive outcome. So another problem that DoubleVerify hopes to solve is viewability. They say that over 40% of unmanaged display and video ads are never seen, which actually that checks out because when I'm watching YouTube, a lot of times I'm just listening to YouTube. So when the ads come up, I don't even see them. I just hear them and wait for them to end, or I click that skip button. So DoubleVerify is working to ensure that when companies use their platform, their ads are actually being seen. Okay, so that's a high-level overview of what DoubleVerify does. Let's get into the financials because, as we can see, DoubleVerify is right near their all-time lows. Today, they're trading at about $19 a share, whereas their all-time low was recently around $18.20. The company has a $3.3 billion market cap, so they're definitely a small cap company, and they are profitable with a PE ratio of around 50, which is actually on the low end for a growth stock. If we look at their financials, obviously with most ad techs, you're going to see very cyclical revenues. So your fourth quarter is always going to be highest. That's Black Friday sales. That's end of year sales. There's always a bigger spike in revenue for any kind of e-commerce or ad tech company in December. That's just how it goes. So I'm not concerned about this drop off in revenue. What I'm looking for is the comparative quarter. So last quarter, they made $140 million in revenue. In the first quarter of 2023, they made $122 million of revenue, so that's an increase of about 15%. So DoubleVerify is still growing on the top line. However, the bottom line is actually down. They made less net income. So what I think I'm seeing here is that the company is spending more in order to get that revenue growth. They're sort of switching to a growth at all costs as opposed to revenue and profit growth strategy. So, okay, that's a bit disheartening because I like to see both these bars going up in tandem. However, they are still profitable. Even though their net income is dropping, that is still positive net income, so I like to see that. When we look at DoubleVerify's balance sheet, they were actually an IPO, I think around 2020, 2021 was when I first started looking into them. And so they still have a lot of that IPO cash because they are profitable, so they're not spending through it like crazy. They have cash of $330 million, and they only have debts of $163 million, so they could basically pay off their debt twice and still have cash left over, which is really nice. If you know me, I say this so much on the channel, you guys are probably sick of hearing it, but I love when a company can pay off all their debt with their cash on hand. It just shows good financial prudence. It shows that they have cash, and with cash, you have options, right? So they can invest in the business, they can advertise more, they can make a little acquisition if they need to. DoubleVerify's balance sheet is just amazing. I love to see it. All right, and let's look at their most recent quarter's earnings report. So we see the same thing that I was just looking at, the increased revenue 15% year over year. That's great. Let's look at their guidance for the year and see if that revenue growth is supposed to continue. So for the second quarter, they're expecting revenue of 152 to 156 million. Let's just look at what it was last year. It was 133 million. They're looking at continued growth of 15%. So growth is not slowing down in the second quarter. That's great to see. And for the full year, they're expecting a year-over-year increase of 17% revenue growth. Okay, so it sounds like revenue growth is going to accelerate at the end of the year, so they're expecting another strong fourth quarter. That's great to see. So growth is not slowing for DoubleVerify, at least not this year. Let's look at profits. Adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, of about 200 to 211 million. Representing a 31% margin at the midpoint. So, wow, so DoubleVerify is strongly profitable with an EBITDA margin of 31%, and they're still growing at the midpoint, 17% year over year for the full year 2024. So that's great to see. So some things, let's just summarize, some things that I like about DoubleVerify: a great balance sheet, good revenue growth, they are profitable, their PE ratio isn't too high, given that they should continue to expand those earnings in the future, and they're trading at a record low valuation. So far, so good. At the end of this video, I'm going to put all three of these stocks on my spreadsheet and see which ones I would actually consider buying. So stick around for that, or just skip ahead if you don't care about the other two stocks. The second stock on the list is Sprinklr, and this is a stock that I have talked about on my channel before. The ticker is CXM, and I'm revisiting them because just look at the share price movement. Sprinklr's back down towards their all-time lows. Right now they're trading at $8.79 a share. So their market cap is, again, $2 billion. You're going to see that theme of the $2 to $3 billion mark. All these companies are in that range. So with small cap companies, there's a lot more risk, but there's also higher potential rewards. PE ratio is similar at 43, and revenue growth is still going strong at 13% year over year. So before we analyze the financials too much, let's just revisit what Sprinklr does in case you didn't see my last Sprinklr video. Sprinklr's ticker stands for Customer Experience Management, CXM. So essentially what they do is partner with companies to analyze customer feedback and let companies know what they should be doing in order to please their customers. So if you're selling products or services to the general public, this is really important because one bad review can really tank your business. Think about it. If you have a good experience with a company, you probably aren't going to leave a review, right? Because you expect a good experience. But if you have a terrible experience, you're definitely going to leave a review because you want everybody else to know about the terrible experience you had so that nobody else has to go through that. I'm so guilty of that. Anytime I have a terrible experience with a company, I'm going to make sure that I reach out to the company and leave a review because I'm not a Karen, I promise, but sometimes people just need to know. And what Sprinklr does is analyze all these reviews and help the companies make informed decisions about what their customers want to see. This is really important if you're getting a lot of reviews and you want to sort of filter through the noise. However, something I also said in my last video about Sprinklr is that this is not necessarily a must-have software platform, it's a nice-to-have software platform. So when the economy kind of goes to these types of companies don't typically do as well because they're not as sticky. However, one thing that is going well for Sprinklr is that they are utilizing AI in their offering, and AI is just the buzzword of the day. Buzzword du jour, right? So if we look at every single one of these facets of their business, Sprinklr service, marketing, insights, and social, at the bottom they all say AI powered. Of course, right? Because everything is AI powered these days. Let's head over to their most recent earnings report and find out what's going on. So they just appointed a new co-CEO. So a lot of times management changes, especially among, let's call it weak financial performance, are usually a bad sign because what that can mean is that the old CEO wasn't doing a good job and he's being ousted, or she, and replaced. Or it means that the old CEO does not see a good future and is stepping down. So either way, a management change is usually a bit of a scary thing for the market, but we should really look into this and make sure that's what's going on. So just like we did for DoubleVerify, let's look at Sprinklr's revenue guidance. So for the second quarter, they're expecting about 195 million in revenue. Second quarter of last year, they had 178 million of revenue. So at the high end, that is still single-digit year-over-year revenue growth at 9.6% revenue growth. So that's not good. So growth is definitely decelerating from 13% to 9.5%. Let's look at the full year. Total revenue of, let's call it 780 million at the midpoint. Last year, they had 732 million. So that's only 6.6% revenue growth at the midpoint. Yikes. Okay. So revenue growth is just flatlining and kind of falling off a cliff for Sprinklr. It's still growth. They're still going in the right direction, but it's a deceleration of growth. So they were growing at 13%. That's going to slow to 9.5%. And then for the full year, 6.5%. That's really not great because when you're a software company, growth should be embedded in your business. Something to look at for Sprinklr would be their net retention rate, which they did not provide on this earnings release. Essentially, what a net retention rate is a percentage of how much you're able to upsell your current customers. So if you have a 100% net retention rate, that means all of your customers are spending the same amount year over year. That's actually not great. If you have a 120% net retention rate, that means every year your current customers are spending 20% more, which just implies you have built-in automatic growth of 20%. So in both their quarterly investor deck and their quarterly earnings release, I did not see any mention of net retention rate, which implies that it's probably not great. If their net retention rate was great, they would be very proud to display that, and they're not. What we're seeing with a lot of companies is that net retention rates are falling just due to the poor economy that we're seeing. And if your company still has a great net retention rate, you're going to make sure investors know. So with Sprinklr, growth is heavily decelerating. However, the company is still profitable. And if we look at their balance sheet, they do still have a really nice balance sheet with enough cash to pay off all their debt if they wanted to. Another nice thing to see. All right, so out of the two so far, I think DoubleVerify is looking a little bit better just because their growth is still staying strong, whereas Sprinklr's is slowing. But let's look at the third company, which is another one that I've visited before, and that is DLocal. So the ticker is DLO, and DLocal is, just like the other two, hitting all-time lows. This is a $2.2 billion company with a PE ratio of just 17. So this is about half the PE that we saw with the other two companies. And we'll get into why, because there's a lot of risks associated with this company. So DLocal has some really nice revenue growth of 30% year over year. However, this is actually down on a quarter over quarter basis. So as you can see, in the quarter ending in December, they had 188 million, and now the quarter ending in March, they have 184 million. So revenue is now going the wrong direction. However, year over year, it's still looking good. Just like we saw with DoubleVerify, net income is down year over year, even though revenue is up. So that also implies a growth at all costs approach and perhaps some margin pressure. So a lot of times with companies like DLocal, which is a payment processor, you're going to see margins get kind of squeezed as time goes on and competition pops up. So let's talk about what DLocal does. DLocal is a payment processor for the emerging markets. So emerging markets is essentially anything that is not a developed market. So think not quite third world countries, but perhaps countries like Mexico or some of the Latin American countries or some of the Asian or African countries. DLocal boasts this single direct API payment platform that empowers global enterprises to reach billions of customers, accept payments, send payouts, and settle funds in emerging markets. So essentially, it's just a fintech payment processor for emerging market countries. If we look here at their latest earnings presentation, here are the countries that they do business in. So we see that they break out the revenues into Latin America at a 68% market share and Africa and Asia at a 32% market share. So Latin America is their biggest segment. They are headquartered in Uruguay, so that is under the other LATAM section. Their biggest Latin American country that they serve is Brazil with a 23% share. The next country overall that they serve is actually Egypt, interestingly, at a 21% share. So what's going on with DLocal and why is the stock hitting all-time lows? Well, some of the countries that they do business in are having a really tough time right now. So countries like Argentina are seeing extreme currency devaluation. So the Argentine peso is also hitting record lows. So that's really not good for their revenue recognition. And countries like Nigeria are going to be the same, where they are just seeing insane currency devaluation. So that's just an inherent risk with a company that's dealing in emerging markets. Is these are not stable markets. So you're going to see a lot of volatility and a lot of fluctuation. And let's get to the bad news. When I do a search for guidance, we see that they didn't actually give guidance on their last earnings report. That's not good for a growth stock. They say our actual performance versus our guidance will hinge mainly on our execution, but will be affected by a few exogenous variables: macroeconomic conditions, there's the buzzword of the day, merchant go-live timing, and foreign exchange rates, to name a few. We are working on delivering our 2024 guidance. At this point, and to the best of our current data and expectations, we believe we are tracking towards those objectives, although with greater likelihood of coming in towards the lower end of the issued ranges. So rather than actually giving guidance, they're just saying, hey, it's going to be on the lower end of what we previously said, but we don't know exactly what it's going to be. Yikes, that's not good. So with a growth stock, investors are constantly looking forward to see what the company is going to be doing in the future. And if DLocal doesn't even know, that shows that this is a business with a lot of uncertainty. All right, let's go to my spreadsheet quickly and look at these 3 companies on my spreadsheet. So this is my sheet where I rate on 4 factors, which are gross margins, annualized revenues, price to annualized sales, and year-over-year revenue growth. The winner of the bunch is DLocal. However, we know that that is slowing. DoubleVerify is in second place. For valuation, Sprinklr and DLocal both sit at 3 times annualized sales. However, between the two, Sprinklr has superior margins at almost double what DLocal has. So if we're looking at price to sales, I always look at gross margins to compare it to, because both use the top line revenue number. And then out of the 3 of them, DoubleVerify does have the highest gross margins of 81%. So even though they do have a higher price to annualized sales, if we also look at the margins, Sprinklr and DoubleVerify would probably be the cheapest of the 2 companies, just looking at sales. These 3 stocks all get a very similar rating on my spreadsheet. Each of these 4 factors gives you a rating out of 5 for a total possible score of 20. My average is around 12. So DLocal is about average, Sprinklr is about average, and DoubleVerify is a little bit below average. And that is just simply because they are a smaller ad tech company, and their annualized revenue number shows that they have not captured quite enough market share yet at only $591 million in annualized revenue. So my spreadsheet inherently punishes smaller companies just because I needed to give some checks and balances. And so large companies that are only growing maybe 4% year over year shouldn't be punished because they've already done all their growing in the past. So this spreadsheet is not an exact science, but kind of gives you a ballpark on how to value growth and blend stocks. Okay, so what would I buy today and what am I buying today? So of the 3, I actually would not be buying DLocal only because of the risks associated with the business. DLocal is either going to be a great investment that is going to just significantly outperform, or it's going to be a terrible investment that is going to sort of flatline and slowly bleed over the next few years. And I genuinely don't know which it's going to be. And for that reason, I'm out, as the sharks say, right? So DLocal is just too risky for me. I really like to try to avoid risk in my portfolio, and especially with a small cap stock that already has risks built in, I want to find the least risky small cap stock to invest in for my portfolio. So I'll be passing on DLocal. With Sprinklr, that is a stock that I used to own that I have since sold out of. The valuation is quite low now, so it might be worth getting back in. So I'm going to be keeping Sprinklr CXM on my watch list, as well as DoubleVerify, which is looking really good with that revenue growth that is still going strong. However, I'm also wondering if companies like the Trade Desk might displace them. So I need to, as a follow-up, look into DoubleVerify versus the Trade Desk, as well as kind of follow up on Sprinklr and find out why that revenue growth is slowing. So I hope you guys enjoyed this video today, and I hope that this helps you in your own investment decisions. Maybe you haven't heard of these companies before, so I hope that I introduced you to some new stocks. If you like this kind of content, please hit the like button. Please subscribe if you're new. And if you dislike this content, please dislike the video and tell me what I can do better. Thank you guys so much for watching, and I hope you all have an awesome day.